Hi everyone. In this particular exercise, what I would like to do is take you through some journal entries, show you the effect that these journal entries have on the accounting equation. Then I will show you what they look like in the different T accounts for the different accounts that we're using. And then finally show you how this will present itself in a trial balance. This worksheet is posted on my website at corebridge.com, and if you go to the link that's in the description below, there is a link that will take you to where all of these downloads are, and this is called transaction analysis. So let's begin with the first transaction, where we are a company that provides website design. We have done this for a customer for $50,000. Okay. Now I already have the debit and credit filled out for you, but you'll notice that if you click on the account, there's a little drop down and you can choose what account to use for the debit and what account to use for the credit. So since we have provided website design and we've gotten money for that, we are going to debit cash. So our debit would be cash, and we have provided this website design. So we've actually provided the service, so the credit is to revenue. And again, this is for $50,000. All right, now, once we've entered that, let's take a look at part 2 for the accounting equation. Okay, so transaction A, we have cash, which is an asset, and we have revenue, which is being listed under stockholder equity. And the reason for that is because revenue, when we earn revenue, and we have expenses that are deducted from that, that money actually ends up in retained earnings eventually, which is a stockholder equity account. So that's why, as far as the accounting equation goes, it's showing up over there. Now, I have down here, this is what our end target goal is for dollars down here. But we can see that based on this one transaction, transaction A, we've got $50,000 assets equals our $50,000 liability plus stockholder equity. So we are in balance so far. The T accounts page, what this shows is that all of these accounts, some of these accounts may have a starting balance. So our cash has a starting balance of $10,000. Now we've done transaction A, and it's showing up with a $50,000 debit, which is exactly what we put in our journal entry. And over here, we're seeing a $50,000 revenue account. So our transaction A has been done correctly. Over here, you'll see that we have a target that we're looking for, that when we finish this, it should equal this amount of money. And then finally, in our trial balance, eventually all of this data will end up over here where we have a target of this amount of money. Okay. So what we want to see is that our debits and our credits are equaling each other in our trial balance as well. So we want to always have a difference here of 0. So far, so good. Let's go back over to the journal entries. So here now we have transaction B, where we provide some design services for a customer for $30,000 on account. And what on account means is that they haven't actually given us the money yet. So we're going to debit accounts receivable instead of cash because we haven't received this money yet. We have provided the service, so it is revenue. So we will again credit revenue for $30,000. Now let's check our accounting equation. Yep, we're good. We have our $80,000 over here, $80,000 over here. We're good because we got $30,000 in accounts receivable, $30,000 in revenue. We're balancing out. Our T accounts, we now see $30,000 here in accounts receivable and another $30,000 in revenue, which is good. We're balancing, and even over here we can see we're balancing these accounts, which is good. And then finally our trial balance. Transaction C. Now we're going to collect $15,000 from the customer in transaction B. And so we will debit cash, we will credit accounts receivable because we're going to take some of that money out of the accounts receivable. And just to check, we go over to the accounting equation. We've actually received cash, we've reduced that accounts receivable. We're still in balance for the accounting equation. The T accounts, we have $15,000 here, and we've got $15,000 here, which is correct. And then our trial balance, we're still in balance, which is good. Part D, we sell the customer a $2,000 gift card. So we've received cash, but now we have unearned revenue because we actually haven't provided them a product or service yet. And then you see the pattern. You look and make sure that the accounting equation is working, and it is. It's in balance. The T accounts, these should be showing $2,000 here, $2,000 here, and it does. And then our trial balance, we're remaining in balance, which is good. So now I'm just going to finish these transactions so that we can have them all done. So our customer in Part D actually redeems that gift card in full. So we will clear out the unearned revenue. Now we have actual revenue. Okay. Here we pay pay our employees $14,000 in wages earned. So this will be a debit to wages expense or wage expense and a credit. And here we will have a credit to cash. We pay $12,000 insurance for the next year in advance. So this would be a debit to prepaid insurance and a credit to cash. We paid $12,000 in rent in advance for 6 months. So this will be prepaid rent, and we used cash. Now, any of these, if you have any questions on them, I have done videos on earned revenue. For example, I've done some videos on wage and salaries payable, things like that. So those can probably help you. But I am giving you the logic for these as I'm going along. We received $600 for a phone bill to be paid immediately. And so this will be a debit to phone expense. We're paying it immediately. Okay. And then we have a utility bill to be paid next month. And since it'll be paid next month, this is actually going to sit in a liability account called accounts payable for a little bit. So we'll choose accounts payable for our credit account, and this will be, the debit will go to utilities expense. Now, the way that this is built is that if we get these correct, if you get the inputs correct as far as the journal entries go, then your accounting equation is going to flow automatically. And so therefore we have a match. We've got $67,400, which is exactly what our target was. That's what I knew it would be based on this particular exercise. The T accounts would all be filled out with what the latest balance in these accounts are. So as you can see, some of these we didn't even have a transaction. We just had a beginning balance, but we had nothing. We had no transaction that affected that balance. And so each one of these has an ending balance of what is supposed to be in those accounts based on these transactions. And as you can see over here, from a accounting equation standpoint, all of this matches. Our target was this, and it has come out to be exactly that. And then our trial balance should be $142,300. So from a end-to-end flow, when you look at, we start with the journal entries, we're doing these during the month. All of this should be in balance from a journal entry standpoint. From an accounting equation, this should all be in balance. And what you're seeing here is that revenue, of course, and these expenses are hitting under the stockholder equity banner because of the fact that they eventually get swept into that retained earnings account. So that's why they're over here. So if you see an accounting textbook problem that tells you to put things into the accounting equation, then you know that revenue and expenses should go under the stockholder equity banner because of that. We can show how they're showing up in the T accounts. Here on this particular tab, the T accounts, these are things that generally are happening behind the scenes in accounting software, because every time we're doing a journal entry, the system is keeping track of what we had as a beginning balance in an account, all the different debits, all the credits, and then it adds up, you know, what that ending balance should be. So this is something we typically don't see. However, sometimes when we're trying to figure out corrections to accounts, an accountant may sit down and actually draw out a T account and figure out where they need to make a correction. But this is typically not seen by somebody in accounting. And then the trial balance. This is something that periodically from the accounting software, you can actually run these. You can run these as often as you want to, and it will show you in order because it's actually listing assets first, then liabilities, then revenue, and then you've got all of your expense accounts. So they're in that order, they're grouped all together. And this way you can visually see if something is going wrong, if you can see that, oh, my notes payable, why does notes payable suddenly have a debit balance in it? That could indicate that there is an error there. So this at least shows you how it flows all the way through. And with the template, the worksheet that I have on corebridge.com, you can download it. And what you're practicing is making sure you get these transactions correctly, and then you can see how they flow through to the other parts of this worksheet because they're already built for you to put them in the right place. As long as you get part 1 correct, then the rest of it will match up. So if you download that worksheet, I highly recommend it so that you can practice this, practice these journal entries, making sure that you can see how they flow through to the other tabs, and that will help solidify in your mind how this flow of information is working from a journal entry to a trial balance. I hope that helps. Please do leave comments, do leave questions if you have any. It helps me as a content provider to be able to help you with any questions that you have and to make sure that my videos are on target for helping you learn. And I look forward to seeing you on another video. Thank you.